Hello, everyone. Welcome back to another episode of the Housing Debrief. I'm Brennen Thomas, economist at Reports on Housing, and today we're taking a look at the real estate market year in review. We'll start at the national level, but if you have any questions about micro level trends, drop them in the comments and we'll get back to you. And we can just have a wonderful conversation there. But as we've mentioned before, there are four seasons in real estate. We've got the spring market, which is the hottest, then summer, fall, and winter. But tucked between fall and winter is the holiday season. It's consistently the slowest time of the year. Buyers and sellers hit pause to enjoy the holidays, spend time with family, and honestly take a much needed break from the chaos that real estate can sometimes bring. So yesterday was November 27th. It was Thanksgiving. Beyond the amazing food that everyone brings together, it's a holiday for reflection and gratitude. So before we dive into the national data, I want to say a quick thank you on behalf of our team at Reports on Housing. We're grateful for every listener, for every subscriber, and everyone who has crossed paths with us. You are truly a blessing, and we mean that sincerely. So to begin, we're looking at total housing inventory. These are year-over-year statistics. The green line represents the 3-year pre-COVID average from 2017 through 2019. The blue line shows 2 years ago. The purple line shows 1 year ago. And that red line there above the blue and the purple line is this year. And so you can see that inventory has slowly but surely improved across the board. Even though mortgage rates have come down a bit, this improvement was expected because demand has been low and more potential sellers are simply tired of waiting for rates to fall. It's been a long 39 months, stuck above 5%, and I am not thankful for that. I can tell you that. So for clarification, this data comes from NAR, and as of today, the inventory stands at 1.52 million homes, down 2% month over month. For perspective, during the Great Recession, we had 4 million homes. This kind of glut of inventory is one of the key ingredients you need for a price crash, and we are nowhere near that today. So last year we were at 1.37 million homes, which was down 10%. The 3-year average was 1.81 million, which is 19% more. So the inventory has been climbing slowly but consistently. But if mortgage rates drop, do not expect this trend to continue. This is the U.S. pending sales index year over year, and that's a measure of demand. The index is normalized to 100 in 2001. So just like the last chart, the colors match up, but this time I added 2002 just so we can reference that so you can clearly see how demand fell off. That drop came from Fed raising rates at a record pace and mortgage rates followed suit. Since then, demand hasn't moved much. We've been stuck at these levels for far too long, and it is not healthy for the market. This is also one of the key ingredients you need for a price crash: low demand, and that part is true. Demand is low, and it has been for the past few years. Here we have the U.S. existing home sales. The first big Himalaya-shaped peak was the run-up to the Great Recession, peaking at 7.25 million units sold in September 2005. The second peak in October 2020 when mortgage rates were at extremely unhealthy low levels, so reaching at 6.69 million units sold. Now look all the way over there on the very right. That's today. We're at 4.45 million units sold. You can clearly see the drop off that followed COVID once rates surged. And you can see that even more clearly here. This chart shows existing home sales compared to the 30-year fixed mortgage rate from Mortgage News Daily. They're a wonderful platform, so if you don't know them already, go ahead and check them out. They have mortgage rates that they change each day, and it is very, very vital for everyone just to know what's going on. So the two move in opposite directions: existing home sales and mortgage rates. When rates drop, they fuel more home sales, and when they rise, sales pull back. So we end up talking about this over and over because the entire market is at the mercy of mortgage rates right now. And so now I want to talk about one of the best things that's happened this year. So first, I have to break that down, and here's a quick explanation. Investors, especially when the economy cools, look for long-term places to put their money, and they usually focus on a few options. But for us, the most important are the 10-year U.S. Treasury bonds and mortgage-backed securities. They go hand in hand. You might wonder why investors focus on long-term mortgage-backed securities. It's because the average mortgage is held for about 10 years. So it's no coincidence that these two are so closely linked. In fact, they have a relationship going all the way back to the 1970s. So this chart shows the spread between mortgage rates in the U.S. 10-year Treasury, and on average from 1971 to today, the spread is 1.76. So for example, if the 10-year Treasury was at 3% today, I wish it was, but it's not, the average spread would suggest mortgage rates would be around 4.76%. So the blue line on top represents 2023. It was a tough year with rates rising to 8% by October. That was not ideal, and we know that, but it was the peak. In 2024, the spread between the two improved significantly, and that's when mortgage rates started slipping into the high sixes at times, ignoring the drop later in the year where it dropped all the way to 6.13 around there, and then all the way back up to 7%. The red line represents this year, and you can see that it's been trending in a direction that is crucial for mortgage rates to improve. As of today, the spread is 2.24. So that's a decent bit above the average 1.76. It has worsened slightly over the past couple of weeks. You can see its rise on the right side of the chart, but that is due to the government shutdown and missing data. With the October jobs report announced that it was going to be skipped, the spread factored in the uncertainty and has moved just a bit higher. And that does not make us happy. We're pretty cranky about that. Thankfully, mortgage rates have still improved. This chart shows the 30-year fixed mortgage rate since 2023. So as mentioned before, 2023 had pretty rough rates. 2024 saw some improvement, and 2025 has been the best so far. So economics is all about trends. You can see one here. Rates have been moving in the right direction. Of course, things can change quickly, but the trend is positive for us. Just for reference, today the rate is 6.22%, and that is unchanged over the past couple of days. And this time last year, it was 6.92%. Gross, no thank you. I would gladly take today's rate. So mortgage rates have significant control over real estate because they directly impact affordability. This scale shows what home price you could afford if your monthly payment was $3,000. Last year, with rates at 7%, you could afford a $563,000 home. Today, with rates above 0.75% lower, the same payment now allows you to afford a home priced at $608,000. That's a difference of $45,000 in just 1 year alone. We often talk about wanting rates in the fives, but it's important to approach it in steps. People from my generation, Gen Z, and millennials need time to adjust and afford a home. Once rates drop into the fives, everyone will get excited and the market will quickly pick up. So for now, steps are needed. Let's get to 6% first, stay there for a bit, and then we can move into the fives. That's what we need. So now we can take a look at new listings and how they've been trending since 2017. The past few years have been a bit shaky, but 2025 has seen more new listings nationally than both 2024 and 2023. In October 2025, there were 384,000 new listings, and this year's peak was 472,000 new listings. For comparison, the big peaks on the left, the Himalayas average 577,000 new listings. So we are steadily moving higher and higher. That improvement is only because of mortgage rates. We can say it again and again, but is crucial for everyone to know. So this is the Zillow House Price Index year over year. The yellow line represents no change in pricing. The dip in the mid-left section of the chart was the Great Recession, and the huge peak on the right was during COVID, when rates were at levels we really should not have seen. They were pretty unhealthy. Since 2022, home values have started to normalize. You can see it start to fall, and they were far too high. And as of October, they are up 0.1% year over year. So it's still positive, and we haven't seen a negative year over year change quite yet. This is the Zillow Price Index month over month, showing how the market can swing throughout the year. On the earlier side of 2025, so on that right side of the chart, you can see it was negative and we had a rough start, but it's been trending positive recently. That improvement is largely thanks to mortgage rates, again, hovering lower and lower. There have been dozens of headlines about delistings soaring, and let's break that down. This chart shows some delistings for September going back to 2016. So at first glance, it might look concerning, but with proper context, truly it's not. It makes sense when you consider with more inventory and sellers who aren't forced to sell, more homes get pulled off the market if they just don't receive the terms or the offer that they want, which is often the case. During the Great Recession, sellers didn't have that flexibility. So today, loans have healthier requirements, which keeps housing stable. And if you don't believe me, Here's foreclosure activity going back to 2005, shown by quarters of the year. The red area represents a Great Recession where many homeowners had no choice but to sell due to poor lending standards. On the far right, you can see 2025. We've just reached 2019 levels, which are nowhere near the highs of Great Recession. This is also the third ingredient you need for a price crash. We're still far from it, and we don't see foreclosure activity surging back to concerning levels. So we're tracking this stuff. If we see anything concerning, we will let you know. I can promise you that. So if anyone tells you that housing is in a bubble that is about to pop, you have a few ways to respond, and I will leave that up to you. So just remember, feelings cannot argue with facts. We are not in a bubble that is about to burst. So instead, you can just give them a wonderful smile, and that's honestly what I love to do. But go ahead and head to our website if you want to subscribe today, which is reportsonhousing.com, and you can get the latest report, which is light at the end of the tunnel. It is a wonderful report for everyone to know what is going on, some things to look forward to, and you can go ahead and subscribe on our website using the code TURKEY for a free month. But before you go, here's a tip. You can get an even better deal by using the code on our social media platforms. We're Reports on Housing across every platform, so check us out. Happy belated Thanksgiving, and we will see you on the other side.